In this episode of We Talk Money, we are talking about the cage match between the Fed and the markets. And is this soft landing making bulls hard?
Hey guys, hold on. Is it time?
Oh, yeah.
Is it time to bring out
She's got the BTFD hat on.
BTFD hat?
We are definitely have been in a buy the dip market for the past couple of weeks. As you can see in the indices and a few other markets, we have a absolute ton to talk about. So we're just going to dive right into it. But before we do, this episode is sponsored by our brand new newsletter, The Daily Dough. If you go to dailydough.co, that's daily, DOUGH.co, we have started a newsletter to help you become a better investor in 5 minutes a day. And Travis, Nikki, and I are all contributing to this. Right now, we're doing it for 3 times a week, Monday, Wednesdays, and Fridays. And we're diving into everything to help you grow your dough, talking about markets, talking about investing and trading strategies, doing deep dives on trends, and looking at news, and not just curating news, but giving our take on it, and hopefully providing some wisdom and strategies to help you grow your wealth. So we're super excited about that. And so far, I think this is our second week doing it, and it's growing like crazy, and I'm just super stoked for it. So let's go ahead and jump into the topic of today, which is, oh my God, CPI just kind of surprised everybody.
Did it though?
Inflation coming way down. Yeah, I don't know. What's your take on this, guys?
I mean, weren't we kind of calling for this surprise, downside surprise? Trav specifically was like very adamant about it.
Yep.
So
yeah, Trav, walk us through your thoughts here. So we'll take a look at your tweet, and you've been calling for lower rates, lower inflation data, and take it from here, bud.
Well, I think what I really want to know is, man, where does the Fed get their drugs? Because God, whatever they're smoking it's too good. It's too good. The Fed is just completely on another planet than the rest of us in the investing world. We've got the CPI numbers coming in today at 3.0% year-over-year inflation. And yes, we're still seeing inflation, but the numbers just continue to come down every single month for the last 8-9 months. And I've called out over and over again here on We Talk Money and elsewhere that we are going to continue to see this trend. Now, we might see a slight uptick in any given month from here on out, but generally, I think we're still going to see pretty heavy downward pressure. A lot of the lagging components, including shelter, the largest component of the CPI, have just now started to roll over. So we're going to continue to see, I think, progress on inflation, yet we have the Fed over here saying that they're not happy with this progress, that they still want to hike rates in July. You know, they took a pause in June, and despite the data getting better, they want to go back to hiking. And so when I look at this, I tweeted about this and I said, the Fed is making the exact opposite mistake of what they did in 2021. In 2021, they sat on their hands as we're all like looking at all of the commodity inflation and general inflation happening in the economy. CPI had ticked up from like 1% up to like 8% before they decided to do any hikes. They're sitting there saying inflation is transitory, blah, blah, blah. And we're like, what are you doing? And here we are again with the opposite. You know, the Fed is going to make another major policy mistake, keeping rates too high. They wanted a soft landing in the economy. It looks like we're getting it, but now we have the potential for the Fed to choke off the progress in the economy. It's like they want to see the economy weaken. They want to see people go into the unemployment rolls. And I'm so exasperated about it. But look, we're investors, so we have to focus on the reality of the situation and not what we want to happen. So we'll talk about what that means in terms of moves, but I think the Fed is once again off sides. But I am encouraged by the inflation data. It is exactly what we expected to see.
So do you think that they're going to keep raising? The market seems to think that, or do you think they're going to pause or even have to cut earlier than expected now?
Yeah, so the market is saying 90+% chance of a hike at the July meeting, just based on what the Fed themselves have been saying over and over and over the past month, is that, you know, they took that pause in June, but they're still itching for another hike.
Yeah.
And Nikki made the point in a few episodes that, hey, maybe we're not at the end of the rate hike cycle, but we're very, very close. Maybe they do another 25 basis points. And so maybe it doesn't matter too much. But the problem is they're also going to be slow to reduce rates when they probably need to at a certain point. And so the market is saying now that they could start reducing rates sometime in 2024. But there are indicators out there that suggest the Fed should be cutting now. And you have the federal funds rate well above where it should be relative to some of the inflation measures. So, yeah, I think it's going to be interesting to see how the Fed evolves their decision making in the next couple of months if inflation continues to cool. And especially once we get that downward pressure from the shelter components of the inflation measures, I think that's when we're really going to see what the Fed is made of. And I don't know, TBD. If the Fed continues to stay too aggressive and they start to choke off parts of the economy, I think we could see some pretty bad downward pressure on asset prices, even though we've been in this extremely bullish environment.
Yeah, like you said, housing just started to roll over. The other major component is car prices, which used car prices have really started to come down, which is, I think, a great sign. I mean, it was just such a weird situation through COVID to see, one of the best performing assets be used cars. That's not really a good sign, but yeah, to see prices here starting to pull back, I think is a really good sign for inflation as well.
Used cars are down in terms of price. New cars, inflation is not down, it's up.
Yeah.
So something to just keep in mind for anybody car shopping out there.
Yep. Cool. So let's talk about the markets then. As of today, on the CPI data, the markets were popping. You've got both the NASDAQ and the S&P that have been in bull trends ever since they kind of broke this short squeeze zone here in mid-May. And markets are really just at this point a few points off of all-time highs. And then taking a look at FANG Plus, it's almost at all-time highs. So really interesting environment. Shorts have just gotten absolutely demolished over the past couple of weeks. What do you guys think? Is this the top, or are we going to see continued strength here?
I think we are in a really interesting period here because you do have the NASDAQ up like 40% year to date. And we've started to see pops in a lot of the really highly shorted, sometimes junky stocks. You've seen a lot of the futuristic SPAC stocks like your IonQ quantum computing stock, or Joby, the vertical takeoff and landing company. A lot of these companies are still years, if not decades away from profitability and sustainable business models. And yet a lot of those have seen pretty phenomenal stock price performance. You've seen even stocks like Redfin yesterday up 24% on basically no news and appeared to be short covering and FOMO buying. Yeah, Carvana's been a monster. I was going to wait to let you talk about that one, but
just another one to add to the junky stocks that are ripping for some
that's
reason.
right.
Yeah, Nick, do you want to tell us about the brief that you wrote a few days ago for the Daily Doe newsletter?
Yeah, so Carvana is a stock that I've been long since May. Basically, I found it in my short squeeze scan. I like to trade short squeezes for those that don't know. I traded GME, the GME squeeze. Trav traded the GME squeeze. So even though we are professional investors, we do like to partake in these, short-term opportunities to get some cash in the account. And what I've noticed is that the short interest for Carvana is very high. It's pushing 50%. It was pushing 50%, maybe down a little bit from there, but it's still quite high. It's not GME high level. Okay. It's not GME high, but it's high enough to where we can really see a nice run in Carvana. So that's what I've been pointing out, is that even though the stock has moved a lot, the short interest, that doesn't necessarily mean that the short interest has declined significantly. And we can continue to see that strong momentum, not only from short covering, but also people starting to buy momentum, in the price action. So that's what we're seeing here. This is probably a mix of, in Carvana, short covering and momentum buying. Swing traders coming in, day traders coming in, just kind of piggybacking off of that. And you know, buying begets more buying, as we know. So it doesn't have to make fundamental sense. It really doesn't, probably. Carvana is riddled with debt. But this could be a situation where, like what happened with Tesla, and Travis has pointed this out in the wealth building community, that Carvana, which is debt ridden, could end up raising capital up here as these prices go higher, which could help them pay down debt, which could help them survive. So it's kind of a unique situation.
Reflexive, completely reflexive. Yeah.
Yeah.
So Carvana, at least, unlike some of these other more low quality stocks, I would say, does have a bit of a fundamental backdrop in that, like you said, if they're able to raise equity capital, let's say even here at $40 a share, you could argue they should probably raise some equity capital, and up another 14% today, by the way, and doubled in the last 2 weeks. But you know, if Carvana raises equity capital here or even at higher levels, that's going to help them delever the balance sheet and actually improve the fundamentals of the company. And the higher the stock price goes, the less dilution you would need to raise that capital. And so you could have a situation where the higher stock price leads to a higher stock price just based on the potential for fundamentals to improve from a higher stock price. So it's quite interesting in that aspect. We call that reflexivity. And we've seen situations like you mentioned in the past, like Tesla or even GME in a certain sense. AMC in a certain sense probably saved itself with the whole short squeeze. Not that it's been a good stock to own long term, but you know, at least short term, they were able to increase their runway of survival because the stock price had spiked so high. So that's what we're seeing here. And there are some people that believe that Carvana can still be fundamentally a much higher valued stock from here based on the fact that, you know, they can get to profitability and continue to gain market share in the online car retailing space. So regardless of that, Nikki, I gotta give you a shout out on this one. It's been a phenomenal trade.
Yeah. How did you play this? You bought it both in spot and you traded some options on it, right?
Yeah, so I bought some call options, and I also bought a spot long position. The call options kind of helped me get some leverage on, you know, kind of juice returns more. And I'm up, I think today, I think I'm up at least 8x on these options.
Woo!
I've been
Hell yeah.
scaling out, of course. I've been scaling out into this strength because I bought this May 15th. So that was back when price was like 10 something bucks. And so obviously when you're up, I'm up. Actually, I'm almost to a 10x, guys, on these option contracts.
Hell yeah,
I'm
that's
up
awesome.
994%
Wow.
on
Sick.
these options. So that's crazy. That's wild. That's where the timing and the technicals, if you're really good at technical analysis and you can kind of try to nail that timing, man, that's where those options can really help juice returns. And then as far as the spot position goes, I'm up almost 300% on the spot position. So yeah, it was in my squeeze scan. Trav, I talked about this like update after update. We do a stock market update every Monday, and I kept bringing it up all through April into May. And I was like, you know, I'm watching Carvana. It's got a high short interest. The chart's kind of setting up. And I was watching and watching and watching. And then finally, price set up and there was some relative strength, I think, at the time. And I was like, I think I'm gonna I like the risk to reward here. So ended up taking the trade and been scaling out, but I still have a pretty core position, most of my spot, and still about half of my options contracts.
And it took some patience there. I think in like late May, it kind of flatlined for a little bit there. And then you got a fundamental catalyst there in June with the company coming out with an update on the second quarter, suggesting that the second quarter was trending better than their expectations. So that helped as well. Just a textbook example here of both the fundamentals and technicals feeding into the outcome of the trade. Phenomenal.
Yeah. And also with used car prices coming down too, that's probably been helpful for the overall idea. But yeah, and you know, the thing that I wanted to kind of touch on this while we're on the subject is I had taken shots at swing trades a few times, not many, but a few times, under a handful, right? And they were all losers. They were all they did not work. They were fake out breakouts, whatever. The market environment wasn't exactly perfect, but when things set up, you know, you sometimes want to probe things and try things. But I wanted to say a lot of people lose their steam after getting loss after loss. But remember, your winners just need to be bigger than your losers. So, if I had this one trade has more than made up for the few trades that I probed at and lost on. And I didn't let that prior mindset of the losses affect me going into this Carvana trade. I went into it with a clean slate, and here I am with a 10x, etc. So I just wanted to let people know that this is an important part of being a successful trader. It's trading less, not trading a lot, which I don't, and B, not letting the past, affect the future trades, because you never know. We had someone in the community, I think, that ended up, getting afraid of the pullback, and they got shaken out. And so, these are the types of things that you want to avoid happening to you. So don't let that the prior losses affect what could happen in the future.
Well said. I mean, yeah, it's one thing in trading that's true is you can take a few strikes in a row and then end up getting that grand slam. But if you screw up your position sizing and you burn up your capital on a couple of losses, or if, like you said, if you get scared out of positions and lose confidence, you're going to miss out on that big recovery trade. It's also the same in like angel investing, right? If you talk to any angel investor that has cut, a dozen or 2 dozen or more checks, they might have, death after death of a startup, and all it takes is one to make up for all those prior losses and then help you make life-changing gains, right? The same is true in crypto, and we can jump over to crypto here in a second, but yeah, there's a couple of breakout trades that I took this year on altcoins that I was like, all right, I know the regulatory environment is weak right now. I know a lot of alts are dying, but let me take a stab on certain things that have relative strength over Bitcoin, because those are the ones that typically work. And then when they fail, it's not that, hey, I'm a bad trader or I shouldn't have taken those trades. It's just, it's a product of the market environment. And that's why risk management is so key, right? So I kept those losses small, and then I ended up nailing the 19K dip buy on Bitcoin, right? And we can also talk about some other opportunities we're seeing in crypto now. But I think the lesson is that no matter what asset you're trading, if it's stocks or if it's startups or if it's crypto or something else, a lot of these principles apply, right? The mental game, position sizing, all these things that we've talked about for many years on this show. And we just like to demonstrate like real life examples of that and show that, we're not just talking the talk, but we actually do this as professionals day in and day out.
Yeah. And this is actually, I think, becoming my biggest swing trade ever, like my biggest swing trade win ever. Because usually swings, thank you. Usually swings, they're quick. You're not going to be seeing those major gains. When you hold long term, it's easier to get those 3x, 5x, 10x returns like, we've had on Square or a few other things. But with swing trades, it's really hard to get like that big return. So this has definitely been a milestone trade for me that has kind of, it helps confidence. It just gives you more and more experience to be better and better as you go.
Congratulations. And now you know what it's like to be a crypto trader.
I know. Everyone that's in crypto is probably chuckling under their breath, oh my God, 10x.
Well, not this year. A lot of crypto traders have just been chopped to pieces. Actually, why don't we move over that? I want to talk about, what's happened in crypto. It's been a really great year for Bitcoin so far. Bitcoin year to date is up over 84, almost 85%. Started off, hot right from the jump of the year. But if you look at the total 3 chart, which is the total market cap excluding Bitcoin and Ethereum, alts across the board are only up about 13%. And really those gains are kind of concentrated in just a handful of cryptos, where a lot of altcoins have just gotten absolutely demolished. And a lot of charts just look like garbage, where they are below moving averages and they're trending down with lower lows and lower highs. And so a couple of weeks ago, I started doing some just deep dives on different ways to basically play the crypto market and maybe get some extra leverage or juice or alpha, even though alts have gotten destroyed. And one thing we've been talking about in the community over the past week or two is mining stocks. So Bitcoin miners are typically a really good play during bull markets, but they get absolutely demolished during bear markets. You can see from the highs in 2021, a lot of these things were down 95% or more, but in bull markets, they can get a lot of juice. So for example, like BT, Bit Digital, was up 800% from the low of the year. And a lot of these are up 200, 300, 400%. I'm actually writing an article about this in the Daily Doe for Friday. So hopefully you guys are subscribed to that so you can see the deep dive on this. But this, I think, is just another way to get some leverage and some extra juice on Bitcoin's price, because again, it's mostly Bitcoin mining, and where a lot of these altcoins typically die off during these bear markets. If Bitcoin's getting a run, say it's up 50 to 100%, some of these miners can be up 200, 400, 500%. Now, one thing I wanted to ask you guys about, though, is like on the fundamental side, right? Because one thing that is kind of an extra layer of risk on this is these are companies, right? These aren't crypto projects, and it's not, a Bitcoin backed ETF or anything like that. It's a company that has profit and losses and debt and risk. And some of these actually go bust during bear markets. But if you can find a company that has relatively strong fundamentals, meaning they have cash, not too much debt, they've got runway, and if Bitcoin continues into a bull market, I think some of these could continue to see some really big upside potential. So have you guys done any work on this? Have you guys looked at the fundamentals on any of these Bitcoin miners? If so, what do you think?
Yeah, we've looked at these a couple of times. To be honest, I haven't looked in depth at any of these in the last probably 6 to 8 months. But one thing I think that's interesting about them is that, they are competing on costs because you don't control the price of your end product, which is Bitcoin. So they're very similar to, say, like gold miners, where if you look over time, gold miners tend to underperform the price of gold over long time frames. But in really strong bull markets in gold prices, the miners will outperform gold prices, and sometimes by a very wide margin. So the businesses I'm not exactly crazy about for like long-term investing, because you look and the margins are very volatile. A lot of these companies, funded a lot of their mining equipment with debt. So there are questions about what does the long-term economic model of these businesses look like. When Bitcoin prices are very strong, margins, are very, very healthy, and they earn, pretty nice positive returns and positive profitability. But in bear markets, like, with Bitcoin at 10 or 15K, they don't really make money. And so you also have this backdrop over the long term of them competing to try to get the lowest energy costs. So you also have problems with what happens if energy prices spike, and what happens if, the companies make bad capital allocation decisions and they issue too many shares to management. So there's a lot of ways to actually lose with businesses like this, and with traditional miners and traditional commodity producers. So I don't necessarily love the business models, but in a bull market for the underlying asset that they're producing, I think they can be really interesting trades. But I'm not loving them for long term.
Yeah, I agree. I mean, there's really no reason to hold these things long term, but on a swing trading basis, if you look at these charts, like even most recently over the past week or two, we've been talking about some of these setups where they've just been giving really beautiful, like, technical breakouts, and the price patterns during a bull market are really nice. Like one DJHI is testing like $2 resistance right now. And last week I was doing a watch list talking about CleanSpark, how it had a $5 resistance level and that broke out, and now it's up close to $7. So I think these could be like good traders to do kind of the strategy that I've done with altcoins in the past, which is I trade them to accumulate more fiat and more Bitcoin, right? I kind of look at these as a potential way to do that as well.
Yeah, well said.
Also, a couple of non-miners have been getting some juice lately, like Coinbase, which I'm still a little skeptical on, but you can see it's been in this range in between 50 to $90, and most recently it's been trading close to that resistance level. I don't know. I know I've said this a lot. I'm still not super bullish on publicly traded crypto exchanges long term. I think there's just a lot of headwinds, but maybe in the short term, especially if Bitcoin's bull market continues before, during, and after the next halving in spring of 2024, maybe we start to see Coinbase and some of these publicly traded exchanges get some juice, but there still is that looming, just regulatory action from the SEC that we need to think about as well.
Yeah, Coinbase surprised a lot of people over the past few weeks because after the SEC charged them, there was a lot of commentary in the investing community, even within the professional investing community, that Coinbase stock could even be a potential zero. There were a lot of bears that bet against Coinbase even just a month or two ago, and now we're in a completely different picture here for Coinbase. I think, though, ultimately where I land is similar to you. I'm still unconvinced on a long-term time frame. I do think it helps that Coinbase, is still seen as one of the legitimate last man standing fiat to crypto exchanges in the US. And they tried to at least follow some letter of the law, but obviously they've got themselves in hot water in other ways. But it's not just a question of, hey, can they get past the SEC stuff? Because I do think they'll eventually come to some terms with them, maybe pay a couple $2 billion fine, maybe have to delist some of the altcoins that they were allowing trading on. But ultimately, I was expecting they'd probably survive. But then the question becomes, okay, what does the long-term business model look like? And, they have a significant portion of their trading volumes in altcoins. They have, declining market share when you look at some measures of, Bitcoin volumes as well. And so you have, a question there about, well, what does the company actually earn long-term? And can you justify even today's valuation? And so where it all nets out, I think, is really hard to know looking 3, 4, 5 years out. So we'll probably see a pretty wide trading band on Coinbase. I'm not convinced long term, but I also thankfully knew enough to just kind of stay out of it. It was like a too hard pile for me because of all these sort of tailwinds, headwinds, and where it all nets out. Again, it's hard to say exactly because there's just still so much uncertainty. And you do have positive catalysts. I mean, what happens if the SEC starts approving all of these Bitcoin ETFs and you have Coinbase as the custodian for a lot of those? So they will benefit and have some fee income from that. But yeah, I don't know. It's a very difficult one to figure out what it looks like 5, 10 years from now.
Yeah, well said. I do think the biggest looming potential bull catalyst is, unfortunately or unfortunately, a BlackRock ETF. It looks like fortunately, but there are risks, right? We've talked about some of the risks. I actually wrote about this in the Daily Doe newsletter. Go to dailydoe.co, sign up for our newsletter. But yeah, I mean, I do think that if the Bitcoin spot ETF does what gold did in the early 2000s, that could be another big driver. So we'll see what happens there. Let's talk about housing. Another really weird mix of data that's been coming out this week. Let me see if I can find the interest rates. Interest rates are climbing back up above 7%. This is actually looking like a breakout pattern in interest rates to the upside. Hopefully not. Hopefully we get some kind of fake out breakout on interest rates to the upside, because I think if we got, close to 8 or 9% mortgage rates, I would just absolutely demolish the real estate market. But Trav, talk about this article that you posted, housing market update. The average U.S. home is selling above its asking price for the first time in nearly a year. Please, God, tell me this is not true.
This is shocking, right? And Redfin is reporting that, looking at their data across all the markets in the US, that in aggregate, the average selling price is now above asking again, which is wild to think about given what you just mentioned. 30-year fixed mortgage rates in the US above 7 and have been heading upwards over the past month or two. So what does it mean? Yeah, I mean, it's consistent with what the home builders have said in recent weeks and months, what the home building ETF has done, what a lot of the housing stocks have been doing lately. It's consistent that, hey, it looks like there is buying interest back in the housing market, that people, despite mortgage rates, are still out there buying because of low supply, because people still want to buy homes. So very, very interesting to see. Now, will it last through some of the weaker seasonal periods for housing as we go later in the year, especially if we see 30-year mortgage rates continue to climb? Who knows? I probably am not as bullish on the housing market as maybe some are out there, just because of what I'm seeing with rates. In fact, we saw 30-year rates on US Treasuries and even 10-year rates on US Treasuries rising a lot over the past month. Just today, after the CPI report, they've come in a bit, which is nice to see a little bit of relief. So maybe mortgage rates can get a little bit of relief here short term. But if mortgage rates keep pushing higher, 7.5%, 8%, that's got to affect home prices at some point. And I would imagine we'd see some cooling in the back half of the year. But the supply dynamic is not going to change that quickly. So rates will change quickly, but supply dynamics take a lot longer to come to fruition. So there are still a lot of US housing markets that are still short on supply, especially in hot zip codes. So it's going to be really interesting to see how things evolve from here. Certainly not the way that housing bears have been screaming about over the past 6 months.
I mean, bears have just been getting their asses beat all around.
Yeah, well said. I mean,
I hate to say it.
Yeah. I do want to say though, there are lurking risks here that we cannot ignore. If the 10-year and the 30-year rates in particular in bond markets, if they were to continue to rise over the next few months, that could put pressure on all asset classes again, like we saw in 2022. Everything looks great right now. We've seen, the market kind of come to the conclusion that the Fed, if they're not done, they're close to done. And so people were bidding assets up again. But I don't know if that continues. There's a setup here where it's kind of a bull trap if you do have the long end of the curve rise, because one thing that was helping these markets was that the long end was not really rising as much as the front end. We had that super inverted yield curve where, rates on the short end rose a lot, but rates on the long end weren't rising as much. And things like stocks and real estate really depend on valuation models that take into account longer duration interest rates. So your 10-year, your 30-year rates. And those were pretty stable. But if you have those rising and those start to really break out at some point, then you do have a serious risk to asset markets here. So I just want to put that in the back of people's mind that it's not like we're out of the woods in terms of the risks from bonds and interest rates. And especially, like I said earlier, if the Fed is still the enemy of markets, at some point that could matter again. So I just want people to have that in the back of their mind here.
I'm wondering if the Fed is just, how everyone thinks the Fed is just screwing up here and they shouldn't continue to raise rates. But if something like housing is still seeing this kind of strength, I guess maybe could the Fed just be afraid that the economy is so strong that they just have to, because if they don't and they pause here, that's going to continue to help inflation going forward? Like we could see inflation start up again. Are they just scared of reinflation?
I think that's honestly probably the biggest driver for them right now is they don't want to repeat the mistakes of what happened in the 70s where inflation had that, big spike, second spike up. And so they don't, Powell is so worried about his legacy. He doesn't want to be Arthur Burns. He wants to be Volcker, who ultimately helped to stop the inflation problem. So I think that's a big part of it. They're not really as data dependent right now as they should be. They seem to be more worried about, things like what if asset markets, get untethered again? What if housing goes up again and we see inflation spike again? I think they're most worried about that, exactly like you put it.
Yeah, because the wealth effect right now, right? Like people are experiencing positivity when it comes to real estate values are not really budging, so their houses are still worth a lot. The stock market is up, about to break out again, right? So people are experiencing that feeling of wealth in terms of their assets. Not everybody. There are a lot of people that are struggling a lot, especially low income individuals or people that don't own assets. So that wealth effect is what helps people spend money, and therefore that's where reinflation can come into play, I guess. Is that the proper word, reinflation? Or
yeah.
Yeah.
I think that's
So
totally
that's
right.
maybe what the Fed is thinking is, gosh darn, these assets won't go down. So we're just going to have to keep really going at this because people are going to feel wealthy. And then there goes inflation spiking. So I don't know. Maybe there is something to that. And that's their main concern. Everyone's looking at them like they're crazy, but I don't know.
Lynn Alden
I get
also.
it.
And Lynn Alden actually had an interesting piece though, which argued that there's actually an inflationary aspect of the Fed raising rates, and especially if higher rates leads to higher real incomes. So inflation comes down, but rates are high. People are now actually, earning positive real returns, holding low
Yep.
risk assets. And
Yep.
their purchasing power and their wealth is growing because of the higher rates. That could actually lead to more inflation, right? That's kind of paradoxical. Yeah.
I tweeted about wage growth. Like we're actually seeing positive wage growth, which is crazy. I don't know. Inflation's going down. It's helping the consumer. And now, like you just said, people are able to protect purchasing power. We have real positive rates. I don't know. It's a cluster.
Yeah. It's tough. I think maybe the best thing for the Fed to do is just do nothing and chill for a little bit, and just kind of see how things evolve.
I think another inflation metrics we could look at is Disney World lines.
Oh, wow.
I don't know. Disney World hasn't felt this empty in years, shorter wait times for rides. I was thinking about this. I'm like, all right, well, is this like, did Disney, I know they jacked their prices up. Did they just like jack prices up and people are, not able to afford it? Or are people doing other things? Like, I know a lot of people are like traveling to Europe this summer and I'm seeing a lot of people posting about that. Are they just doing other things? Or is this a bellwether that, people don't want to spend money or they just can't afford it anymore?
Yeah, I don't see any other metrics in the world of travel that are weak, really. I mean, you look at air travel numbers continue to be consistently higher than last year and even pre-pandemic in 2019. In fact, I think the busiest air travel day ever happened last week. And the, travel stocks, even cruise line stocks seem to be doing pretty well. So there's not really a whole lot of indicators I see out there yet as far as travel is concerned that would indicate weakness. So this may be a Disney specific problem, and I know that they made some choices too with their political decisions that may have ruffled some feathers there, and so there could be an aspect of that as well.
Cool. Talking about political decisions and ruffling feathers, what do you guys think of Threads so far? I know this was like the fastest adoption to how many users do they have now? Is it over 100 million?
200 million?
200 million?
Last I saw was 100 million, but if it's as
Okay.
much as 200, that'd be
I
wild.
thought it doesn't say it in that article. Threads will reach close to 200 million daily active users.
Yeah, that's a
And within the
projection.
next 2
Oh,
years
in
is
the
what they're
next 2 years.
estimating,
Okay,
about
yeah.
8 billion in revenue.
Okay,
Yeah, I don't know what are y'all's initial thoughts on Threads?
I think. Oh yeah, go ahead.
Go ahead. Well, I'll just say my initial thoughts are I think that it could bring Instagram and Facebook users into the Twitter format. A lot of people on Facebook and Instagram don't use Twitter. Like a lot of them that I know at least don't. So I think that could give them that exposure to that type of platform. So that's the positive. Trav?
Yeah, I do want to see the alternative flourish just because I think, Twitter's made some questionable product decisions, and the Threads opportunity I think could be really interesting, especially if they develop features quickly, because there's a lot of features that Twitter users have wanted forever that, just never really got fully developed at Twitter because they were so slow in developing product features. But the thing that I'm struggling with right now with Threads is there's a pretty bare bones set of features, and we talked about this in Daily Doe. I'll just put the mention in there again. But we talked about how currently today the feed is only algorithmic. You can't create lists and curate your own feed very well on Threads. You've got no bookmarking. You've got no advanced search. You've got the lack of a ton of features that I think are core to the Twitter type of product. And Threads, the leaders of Threads have said that they're going to rapidly develop features, but they haven't done it yet. So for me today, the utility of Threads just isn't quite there. And then you've also, of course, got the aspect of people who've been on Twitter for a long time and have a big following and have built up the follower graph. It's not as seamless to just port that over super quickly. But I think if anybody is going to create that alternative that can be a challenge to Twitter, it's probably Threads, because like Nikki said, they've got that connection to Instagram, connection to Facebook. So you can pull over that user base quite quickly, like we've seen. So as long as they develop features quickly and roll them out quickly, I'm talking the next like 3-6 months, then I think it's got a shot. If they drag their feet a little bit, people are going to forget about it. People are going to stop using it, and it's going to become, kind of a ghost town. So I think really we'll know a lot more in the next 6 months.
I actually think they messed up by making it its own app. I think what they should have done was integrated it and do it in Instagram, to where
Mm.
when you're on Instagram, you've got your, you know how in Twitter you can kind of you can scroll side to side between who you're following and the algorithm and what it's picked for you. In a similar way, they could have done that, where you log in Instagram, you've got your Instagram feed as you see it now, and then if you swipe, that brings you to the threads side of things, where it's got, you know, eventually it would function the exact same way Twitter does. You'd have your spaces or whatever they end up calling them, and it's in Instagram though. So I think personally they messed up on that, but we'll see. Maybe I'm wrong on that.
Yeah, we'll keep our eye on it. Guys, we've got some questions that came in through the website, and just wanted to also, we got some Twitter questions. Nikki, what can parents do to get their children interested in investing? Sloth Investor was asking.
Yeah, love sloth investors. So basically, one thing that you can do is open a custodial account for them, and you can actually buy investments on their behalf, so they get access to it when they're 18. So that may be a good thing or a bad thing, depending on what you want to accomplish. But what you can do is kind of sit down with them and say, "Hey, what's your favorite toy, or what's your favorite video game to play? Oh, it's Roblox. Oh, it's Nike. Let's buy. Did you know that you can be an owner of Nike or Roblox?" You know, and then show them how they can do that, and buy a share in front of them and show them how it grows. And really just kind of showing them how they can be an owner of something, and how money can grow over time. Like, for example, my niece today was like, "I want to save more money. I want to, you know, learn how to save more money instead of spending it." Boom, right there. That's an opportunity to do something like that, and show them how money works. Hands on. They're very hands on. There's a app called Greenlight too, where you can send money to their card. They can invest, things like that. One of my someone that I know has their child on that, and she messaged me and was like, "What should I invest in?" You know, and I told her an ETF to invest in, and she's learning about ETFs. So it's really just giving them these different accounts, these different things that are very visual, that you can sit down with them and show them how it works, and explain how they can be an owner of some of their favorite businesses.
I love it. Get them started young. Travis, we've got a question for you. Catalin was asking, please explain the difference between CPI and US core PCE price index, as the last one's going up, and is what the Fed is taking into account for rate decisions.
That's a really good question. It's a wonky question. So a little bit of an apples to oranges comparison there, because but let me start at the high level. So you've got two different measures of inflation for the US. You've got the CPI, which is the traditional consumer price index, and then you've got PCE, the personal consumption expenditures. You actually have a third one as well, PPI, which is what the measures producer prices, what businesses are paying. And CPI and PCE differ in a couple of different ways. They differ in how they're constructed. PCE uses a different methodology. It actually covers all households in the US, whereas CPI actually only covers urban households. CPI and PCE, really the biggest difference from a practical standpoint is their weightings of how they weight different items in the index are significantly different. So for instance, CPI, they have shelter as their largest weighting, and it's over 30% of the weighting of CPI. So it's massively impactful. And then in PCE, I think your largest category currently is healthcare services. And shelter is only half. It's like 15 or 16% of PCE. So it's just a slightly different measure of inflation with different weightings. And also PCE has some differences in how often they update their weightings and things like that. So why the Fed prefers PCE over CPI, it's a little bit less, tends to be a little bit less volatile. So it didn't increase as much as CPI over the past year, but it's also been flatlining a lot more. And so it's been a little bit slower to come down because it didn't spike up as much as CPI. So it's a little more stable, a little bit less volatility. Now those are the headline CPI versus PCE. When you talk about measures of core inflation, you have core CPI and core PCE. And what those essentially do is they take out the impacts of food and energy prices. Food and energy, those tend to be the most volatile components within any inflation measure. And so there are core measures that try to look at what inflation is, excluding food and energy prices. I don't like core measures of inflation because food and energy prices dramatically affect your actual consumer. And so I don't really love looking at what would inflation be if we excluded food and energy, because
people don't travel or eat.
It's
right,
dumb.
exactly. And energy prices feed into so many other components of CPI. So I think it's actually really important to look at the energy component of CPI. But nonetheless, the Fed does they say they look at multiple measures of inflation, even though PCE and core PCE might be some of their preferred measures. They do look at a number of measures. But right now, what we're seeing in PCE is that core PCE is a little bit flatlined. It hasn't come down a whole lot. It's sitting around the 4.5% range and has for the past few months. So it's not really improving as fast as CPI. That's core PCE. Now, if you look at PCE headline, which does include food and energy prices, it has come down. And in fact, it's under 4%. So similar to CPI, it has improved over the past few months. And I believe its last reading was like 3.8% for May. So the next time we get the personal income and spending data, that's when the PCE numbers will come out again. So we'll know what those numbers look like. But overall, I think if you look at both the PCE and CPI, you do see improvements. Core, you see less improvements, but again, I just don't know how truly relevant core is. Maybe the Fed can use that as justification to stop or to not cut rates. But I think if you're trying to measure the actual impact on consumers, I think it's pretty clear from both measures that we have seen improvement recently.
Well said, man. Last question, then we'll start to wrap it up here. Joey was asking, don't we always get a new all-time high in Bitcoin after the halvening? Seems premature to get it this year, no? Yeah, I mean, look, every market cycle is a little bit different. What we do know is that in the prior two halving cycles, the bull market has started 300 to 400 days prior to the halving cycle, and then the bull market ends 400 to 500 days after the actual halving. So we know that there is a large period of time, at least in prior halvings, where we've gotten bull markets. So there's no rush to try to pick the bottom or the exact top, because we get plenty of time to trade that kind of massive bull market. Will that continue into the future? Who knows? I expect over time, as the market matures and we reach more and more mass adoption, that volatility will decrease and exponential gains on a percentage basis will probably not be as big as prior market cycles. But yeah, I don't know. We're just letting price action be a guide at this point. And right now we are in a bull market price structure. As you can see, the market bottomed in November of last year, broke out in January, and has been making runs and retracements to the upside, making higher highs and higher lows. And yeah, as of right now, we've got like basically 9 months or so until the next halving. And until something changes, I expect that to continue to be true. So yeah, it's hard to exactly say when the all-time high is going to happen. I can run different models to come up with ideas, but at the end of the day, I'm not making like some kind of levered bet on exactly when the new all-time high is going to hit. I'm just trading the trend as it develops. So what's happening over the next week, guys? What do people need to be aware of? What are you looking forward to? Any trends, any news you're looking at, any themes, ideas that people should be looking out for? I know on my side, again, I'm dialed into the Bitcoin miners. I've been really, really conservative with altcoins. I'm looking at the 31K breakout zone on Bitcoin. What else should people be thinking about?
Earnings.
We're going back into earnings season.
That's right.
Seems
Starts
like we were
Friday.
just there.
Yeah. Earnings season runs for about half the quarter. So it does feel like we're always there. Big banks report earnings on Friday. Next week, we get some more companies. And then week after that, really get the bulk of the S&P 500 reporting earnings. So Q2 earnings reporting season, we're going to be super busy on the stock side. There's probably going to be a lot more big moves happening because of it. And then also we get in 2 weeks, the Fed meeting. So actually, 2 weeks from now is going to be a busy week with news and items coming out and big moves in the market, we think.
Yeah, with that headline on housing prices, I guess we're getting that 25 basis points.
Yeah.
Yep. Well, if Carvana keeps going, I mean, we're getting a pretty big rip intraday here.
Yeah.
They're going to need to bump rates just because your profits are so massive.
Oh God. I am pretty proud of myself on this one. It's taken a lot of patience, a
Yep.
lot. And that's with scaling out. It's still taking patience.
You know, it's funny. Hindsight's 2020, and whenever I try to explain to people that like sometimes holding a profitable trade is more stressful than holding a trade that you're actually underwater in, because you know you've got these like unclaimed gains and you're looking at these paper profits that are sometimes it can be life-changing gains and sometimes it's just, you know, really good profits. But when you're looking at that, it messes with you because it's like you want to take it, but you know there's that balancing act where it's like a trade is intact, let it work, and those gains could go from significant to holy shit significant. And the stress level, the bigger the profits become, the higher the stress level, at least for me, goes. And that's where just zooming out and focusing on targets, I think, is really helpful.
Yeah, and we're at a target. This is literally us approaching the major target, which is prior resistance. And then from there, basically, it's open air until about 60.
Ooh.
So could it get there? It could, but you know, you got that issue where they could announce a capital raise and we don't really know how price is going to react to that. So it's definitely going to be interesting to watch.
Yep. Awesome. All right, guys. Well, we'll go ahead and wrap it up there. Again, go to dailydoe.co. It's going to be the best financial investing newsletter out there. We think, of course, we're a little biased, but the goal is to help you become a better investor in 5 minutes a day. We're going to give you trends, our perspective on news, different trades, investments that we're taking a look at to really help you improve your skills and get dialed in and stay ahead of the curve. So, all right. Well, thanks, guys, for joining us. Go to wetalkmoney.com. Make sure you're subscribed to the new YouTube channel. Leave us a review on your favorite podcast platform. And we'll see you guys next week. Take care.
Yeah, thank you.